Year over year, we're still substantially higher than the year over year last year was 5.7. So while we see some signs, particularly on the high end, it's still a pretty high growth market in terms of prices, and it's still showing scarcity.
So Aaron, you did a study or a survey of some economists, including Susan there, indicating that while this trend seems to be small right now, it may gather steam, and that by the year 2020, we may have moved from this prolonged seller's market that housing has been in for nearly a decade into something approaching a buyer's market. How and why do you see that happening?
That's right. You know, I think we've been in such a strong seller's market for the past few years. The slightest news of a little bit of a slowdown has really prompted a lot of wishful thinking, perhaps among buyers out there, hoping that this is more than it actually is. It's important to keep in mind that the housing market, home value appreciation has slowed, but it's still triple its historic pace, 3 times the rate of wage growth. It's still a seller's market. It's going to continue being a seller's market unless there's some dramatic shifts in inventory or a rapid increase in mortgage rates. Our panel of economists, including Susan on aggregate, point to it not shifting toward a buyer's market until sometime in 2020, so a year and a half out at best.
What happens in 2020, Susan? Does the inventory picture improve? I mean, what changes
Well, I think the consensus forecast that Aaron pointed to is a recession, and a recession from the business cycle. But from the housing market, if there were a substantial increase in mortgage rates, the housing market itself could cause the downturn, and that would do it if we have substantial enough rise in mortgage rates.
So it's really a mortgage rate driven or an interest rate driven slowdown in housing or interest rate driven slowdown in the overall economy that brings housing down with it. Am I understanding it right, Aaron?
Actually that's a typical.
Yeah.
That's from what we see historically.
Aaron, you're nodding.
That's right. You know, I think mortgage rates are gradually rising. They've been very slow to increase, particularly for those longer-term interest rates. They'd have to increase pretty sharply, which would hit affordability pretty hard. That said, the other kind of elephant in the room right now is inventory. Inventory is gradually perking up, but it's been very slow to recover during the economic recovery. New home building has remained slow. We know that sector faces a lot of headwinds as well.
What about those wonderful millennials? What are they doing, Aaron?
They are. You know, millennials have actually been, despite expectations, despite stereotypes about them living the hipster urban life, they've actually been driving the housing market for the past year and a half, out there buying homes, buying their first home, starting families. You know, right now we're seeing home value appreciation in the suburbs grow faster than in urban areas. You know, they're moving out of their urban apartment and buying the classic suburban home right now.
That is definitely, Susan, happening where I live in New Jersey. God bless the people who are coming from Williamsburg, Brooklyn, and elsewhere in Brooklyn, coming out and buying houses in my town. It is those millennials. You seeing the same thing?
Yes, absolutely. But there's room to go there because we still see very low rates of home ownership among the millennials. 32%, that's about almost 10% below the historic norms. So there's a ways to go there as well.
Susan, do you see any role for tariffs and for taxes? I mean, there's these new adjustments that don't allow the same sort of mortgage deductions playing a role in where we see housing going?
I think that the overall income fundamentals is far stronger than that, except for some markets. And those markets may be the high-price markets, which are where the pressure, the slight slowdown in price growth is at the high end. So that may be a role there.